Thank you very much for joining us. My name is Enzo Morales. I'm a branch manager here at C2 Financial, and we're here today to talk a little bit about non-QMs, non-QM loans. I guess the question that I've gotten over the last week is, why are we doing this? Why are we here? And really, it's kind of having a conversation in helping to encourage everyone to have some new ideas, some new concepts about achieving success in a changing real estate market. As we know, in 2022, we've already seen things swing. The pendulum is starting to swing, right? We were hot and heavy all of 2021, obviously 2020 as well. And now as the new year came upon us, the first quarter of 2022, things have started changing pretty dramatically. We've seen a rise in rates. We've seen buyer demand kind of go through the roof, and now it's starting to waver a little bit. I heard yesterday from an agent that I work with that things are starting to get a little frothy. I think that's a great way of putting it. So we wanted to have this webinar and these panelists to come and kind of just share some of their experiences, and specifically talking about scenarios where non-QM loans either have been useful or can be useful for your particular buyer or the type of buyer that might be out there that you might be able to, you might want to look for. So I'll just kind of introduce myself. I've been doing this for about 22 years. I've been in the mortgage industry, specifically through retail. I've worked at some of the biggest banks in the country. I've worked for direct lenders. And most recently, in the last 3 years, I became an independent mortgage broker. Part of the reason for that is to have the flexibility when markets do shift and change, to be able to not only work with the types of banks that we were using in the last 2 years when we had paper, low rates, to now obviously adjusting and pivoting our business practices to serve those who maybe are underserved or have been underserved in the last couple of years, because a lot of the focus and attention has been on just low rates, paper, et cetera, et cetera. So what is non-QM specifically? Non-QM loans are not required to meet any agency standard documentation requirements outlined by the Consumer Financial Protection Bureau. So in other words, an interest-only loan is considered non-QM. A loan where you would only underwrite using bank statements is non-QM. A loan where you might have a jumbo loan, but it specifically has some mortgage rates, but still eligible as a non-QM, wouldn't be eligible as QM. So big banks don't do non-QM. That's probably the most important thing to understand. So without further ado, let me introduce our panel. We have some folks here who are going to be joining us, and I'll have them kind of introduce themselves and speak a little bit about their own business practices. But first, we're going to introduce Julia Sherouse, and she is an account executive for FundLoans. FundLoans is based out of Encinitas right now, and they're going to be moving their headquarters to Carmel Valley, down by One Paseo off of Del Mar Highlands. And she's been in the business for over 15 years. And most recently, she's been focused primarily on non-QM over the last 7 years with FundLoans. On her free time, I know she enjoys yoga and hiking and being outdoors. So Julia, if you wouldn't mind, just say a quick hello to everyone, and thank you for joining us.
Yeah, thank you, Enzo. Thank you for having me today. Like you had mentioned, I've been in the industry for over 15 years. I started in subprime, and a lot of people will confuse non-QM with subprime. So there is a distinction there, and we'll figure that out down the road. But went into paper lending and then landed in non-QM, and I've really focused on that over the last 7 years. So I really enjoy it. I love digging into these files and finding ways to qualify borrowers that wouldn't otherwise be able to qualify. And so I hope you guys find some good, useful information today from this webinar.
Wonderful. Thank you so much. Next, I'd like to introduce Mark Wilson. He's the managing partner at CWDL CPAs. He's got 25 years of experience in the industry and actually was a mortgage banker at one point in his career. He loves to travel and spends a lot of time in the ocean, which, that's a great place to be here in San Diego. So, Mark, thank you for joining us. Please tell us a little bit about your background and kind of, what we're looking forward to today.
Yeah, sure. Thanks for the introduction. Thanks for having me on the webinar today. Yeah, it's funny. I started this firm, the idea of understanding that when I was a mortgage banker, there wasn't really a firm that specialized in industry like this. And it's a super complicated industry. I know everybody out there who's involved with it has to deal with interest rate fluctuations, market changes, and it's a highly regulated and difficult industry to navigate. And so we went out to build a firm to hire the smartest people we can find to serve that industry. And it's been a fun journey over the last 25 years, seeing all the peaks and valleys and growth and really how important it is to be nimble. And I think this webinar is going to point out some of those opportunities that exist in today's environment. So happy to be here, happy to contribute in any way I can.
Thank you. Thank you so much. All right. And last but not least, we have Catie Young. She's a partner of Griffith, Young & Lass, a certified family law specialist. She has over 10 years experience in family law. And like my wife, she's an avid tennis and pickleball player. And I think I'm going to have to set up like the full-on showdown between my wife, Danielle, and Catie to see who has superiority on the courts. So,
oh my goodness.
Catie, please tell us a little bit about yourselves and say hello to everyone.
I bet she does, but I will be taking my lessons soon. So I'll be a good competitor. Been in the space of family law for 10 plus years. Hopefully I can bring a little bit of a unique kind of view to this whole realm. I think I specifically kind of asked you who the viewers were here because realtors, lenders, and financial advisors, we work with all of them very often. In most cases, specifically here in San Diego, but I believe everywhere, they're very highly contested cases. So happy to contribute. I appreciate you asking me to be here and looking forward to this seminar.
Wonderful. Thank you. All right. So let's get on with it. Today, I want to talk a little bit about expanding the credit box. And this is a term that we've been using here around our office with regards to really thinking beyond the A paper, the low rates, refinance purchase, really helping certain clients, the types of clients that we're going to talk about today, to kind of get access to financing. Over the last 2 years, lenders and real estate professionals have been primarily focused on A paper. There's been an abundance of buyers because of the low rate environment that we've been in. But now as rates start to climb, we're seeing less buyers due to the affordability gap that's been created, due to the changing environment. There's a sector of the community that's been, like I said, underserved, and it's factors like new self-employment, recent credit events, et cetera. So I want to start off with Julia. Maybe you could tell us about some specific scenarios where non-QM has been able to assist your clients when conventional loans could not. Scenarios where maybe non-QM have helped specifically with, people, for example, with credit blemishes. Maybe you can touch on foreign nationals. But go ahead, Julia, and just tell us a little bit about some scenarios where that maybe jump out at you that you've been able to help people that couldn't be helped otherwise.
Sure. Yeah. So two of the most popular programs that we offer in non-QM are our bank statement program for self-employed borrowers and an investment program for our investors. So those are the two that we have seen most underserved in this industry. Self-employed borrowers, they make up such a large population of California for sure, but of the nation as well. And I know I originated for a short period of time, and I would find that the self-employed borrowers were the toughest to qualify conventionally. So you tend to push those guys aside and you work on the low-hanging fruit that's easier. So in the market that we've seen originators that are really focusing on those conventional borrowers that aren't so tough. But what we do here at FundLoans is we take a look at those self-employed borrowers, and we can take a look at their bank statements, and we can cash flow them through their bank statements instead of using tax returns. So like our panelist, Mark, he's an excellent CPA. He can help these self-employed borrowers to write off, a lot of different expenses. So their bottom line is much better from a tax perspective. But when you go to lend from a mortgage standpoint, it's a little bit tougher to get these guys qualified. So what we do is we take a look at the actual deposits into their business bank statements, and we see what the actual income of the business is. We apply an expense factor once we find out from the bank statements what that income is going to look like. We always have to build in an expense factor for the business. And depending on the type of business, that can be anywhere from 50% all the way down to a 20% expense. And in some cases, it can even be as low as 10 or 15%. But But this way, we can get their actual income just by looking at their bank statements. So recently, I did a loan for a borrower who owns a transportation company up in LA, and big trucks and transporting dirt, all these different things. A business I'm not too familiar with, but I became familiar with it by looking at his bank statements. He does very, very well. We were able to pull the income from looking at the most recent 12 months bank statements, apply to 50% expense factor. We still had plenty of income to qualify, and we're able to qualify him to buy his first home, actually. So he was also a first-time home buyer.
Had he been turned down by other lenders, other banks?
Oh yeah, because he wasn't able to qualify using his tax returns. The write-offs were too big, and he just didn't have enough income, bottom line income on the tax returns to qualify. So the loan officer came to me, said, what else can I do? We can't get him approved, Fannie Mae or Freddie Mac. And so I told her about my bank statement program, and it worked out beautifully for her. Wow,
that's awesome. Do you find that sometimes these folks, these buyers feel a little bit dejected because of the process of trying to qualify on more conventional terms?
Yeah, because sometimes they have been declined by another lender, and they don't even realize that these programs exist for them. And sometimes loan officers don't know also. When you're truly focused on that conventional side of the business, there are many broker shops, banks that only look at tax returns. They don't look at these alternative ways of qualifying your borrowers. So depending on who you go to as a borrower for your lending needs, that loan officer might not know about non-QM products, but they've been around forever, but just not widely used. But okay. there is a shift that we're seeing, because I am seeing loan officers reach out to me for webinars such as this to learn a little bit more so that they can educate themselves and their borrowers.
Awesome. Thank you for the insight. All right. Catie, let's move on to, you and I had a conversation prior to today with regards to divorce situations. I think in San Diego, again, statistically, this is one of those things where, I want to let you share on this, but I've come across scenarios personally in my career, in my practice, where you have a marriage that's coming apart, a divorce situation, and you have a single income earner. So there's only one spouse in the relationship that actually in the household that earns income. And then getting that other non-income earning spouse to qualify for something, usually there's a little bit of a time lapse, usually 6 months before most lenders will allow for alimony to kick in. I don't want to get into the weeds on the product itself and how we would qualify. I wanted to actually have you just share some stories where you've seen as marriages coming apart. You mentioned something about, one spouse trying to hold on to the family home for the kids, or trying to buy something that's suitable for the family, depending on custody and that sort of thing. So I'll kind of let you speak on that a little bit. I don't want to take anything away from you, but Catie, if you wouldn't mind just sharing some of the stories where you've come across some challenging situations from a mortgage perspective and real estate perspective.
Yeah, one of the, I think, best examples of that is, as you say, you go from one, household income now to two. You have typically a payor and a payee of support. So whether it's husband or wife, we can call him payee, now wants to either refinance the home to stay in the marital home with the children, or wants to go out and purchase a new home. Oftentimes, you have to show your support, what that support order is going to be. You have to go and you have to get an actual support order, whether it's a stipulation or it's a court order from a judge. And then I think you would have to take that then to your lender to get approved. So that would be one, example that this program or product would be really good for that. In any divorce case, as I kind of stated, or most, I would say the majority of divorce cases, it's very highly contested. No one trusts anyone. So from, I think, both a real estate, a realtor standpoint, as well as even a lender standpoint, you're typically representing, you're not representing both of them, but from a lender standpoint, you're only going to be working with one party. And so you want to gain the trust of the other party. You typically, during the marriage, you're going to have to get a quitclaim or an interspousal deed. And from a realtor standpoint, because no one trusts anyone, you kind of want to work with both counsel or both parties to feel like they really are trusting of the other of the both parties. So they want to use you. So I think that, like I said, the main example here would be when you have one payer and one payee, and how that refinance or purchasing a property, but really you want to gain the trust of both parties in a highly contested case.
Okay. I had this actually happened a long time ago in a situation where the divorce was taking place, and there was a family business, but the family business had only been run in this case, the husband's name. Now, because of the divorce situation, the spouse, the wife, was going to be actually receiving 50% ownership of that business, and the business was cash flow positive. However, when they brought me the tax returns, because she had never technically earned any funds from the business, even though it was making it was netting millions of dollars a year, she actually couldn't qualify. And this is going back some time now. She couldn't qualify because she technically didn't have history of having received any income up until she took ownership. It's like a brand new inheritance, right? So that's where Julia, going in, this is where like the idea came from to have this panel. It's like, well, if you have this new business that you're now taking 50% ownership of, and maybe it's a passive ownership. In other words, she's not going to be an active voice in the company, but by all means, she's going to be getting 50% of the income from this point forward. How do you qualify using income that historically you've never received as a self-employed borrower? And I think that's where we come into the bank statement piece, right? The business bank statement, what Julia has just been talking about. Those are also little solutions that I think from a lending perspective, we can offer. I think that, we think of this box and it's this big, and this is the way we have to do it because this is what Fannie and Freddie have told us to do. And this non-QM piece now is allowing us to kind of expand our horizons on what is actually possible and how we can serve all types of clients. So have you come across that, Catie, and as far as when people kind of, inherit, I don't want to say inherit. I don't, what's
it's a buyout. It's really a buyout, actually. Yeah. Typically is because you're not, like I said, typically two parties are going to continue to run the business, even if they are a partnership, right?
Right.
So there's going to be a buyout. With the buyout, once you get the business appraised, there's going to be some type of buyout. How you're going to equalize that, who knows? But absolutely, that would be, and that could come with an agreement several months down the line. But in most cases, you're looking at 4 years down the line. People want to get on with their lives before they go to trial. And so they want to go out and purchase property or move out of the marital home. And so those things could be considered. I think we need to start with the appraisal to see what the buyout is. But then once you have that, you can look at the bank statements. Absolutely.
Sure. All right. Well, great. Mark, it's for you. I really wanted to direct the question about some of the clients that maybe you've worked with. Obviously, you work specifically with business owners. Also wanted to talk to you if you had any specific experience with the inheritance of a business or an estate, maybe a series of properties with no previous history of income as far as rentals, or an income windfall. Maybe you can just kind of share with us some of the things that you've seen from your viewpoint about self-employed borrowers, entrepreneurs specifically. I know you're involved with the San Diego EO Entrepreneurs organization. So maybe some of the stories that you might have seen in the past that would be relevant to this type of a solution.
Yeah, I mean, I think it's a good point, and I think everybody here has kind of touched on it. Nobody wants to pay taxes, right? So everybody comes in wanting to limit the amount of taxes they pay, with the same time wanting to be able to qualify for the most that they possibly can qualify for. So there is a trade-off in that scenario when you go down the traditional lending path. I think asset-based lending on the QM space creates tremendous opportunities for people to get into houses and investment properties and multi-use units, and all of that becomes available when you start looking at these other products. I joked about when we first started hearing about non-QM as a title of the loan programs that came out a few years back. I was at a conference and we're starting to learn, like, why are we calling these non-QM loans? Non-qualified mortgages is what that means. And it's exactly opposite. It's just a different way of qualifying people through the bank statements and other forms. And so I think those of you who might be on this call who think this might be subprime or somehow the old alt A where all they cared about was a FICO score and they used algebra to qualify you. That's not this. This is a different type of program. It's safe. I think a lot of the delinquency rates are incredibly low, and it's a high quality program. So I know that wasn't the question, but back to your question on when there's a windfall, I think this common sense type of underwriting where the non-QM lenders can look at your assets, understand where the money is going to come from, understand how you're going to pay back the mortgage that doesn't fit in the exact credit box as Fannie Mae, Freddie Mac, FHA loans, or even VA. Some of that you get pushed out of the market when you don't fall in those categories, and this is a tremendous opportunity for those people.
Yeah, I specifically, I actually shared a video, and it was part of the invitations that we were sending out for this webinar. One of the loans that we actually closed with FundLoans with Julia, it was a borrower who had been turned down multiple times through the big banks. She's a doctor, and she actually was a refugee, came from a country where certain opportunities weren't afforded to her. She came here, got her medical license, and started her own practice here in San Diego. Was about in the third year of her practice. So her first couple of years tax returns weren't looking that great, simply because of the fact that she'd been building a practice. You reinvest into your business to try to grow it, to set up a foundation. But in this last year, her cash flow was pretty significant. And she'd been turned down, first time home buyer, wonderful individual. We worked with her very closely, and her dream was to own a home here in the United States, and had been turned down by multiple banks all over San Diego. It was actually really sad. She was so dejected when she came to us. So we worked with Julia and her team. We got her approved, and all we did was utilize the cash flow from the last 12 months of her practice, which was a 7-figure cash flow. They did their calculation, and she had more than enough money to qualify for a $1.4 million home. She purchased it. We closed it in 30 days. This is somebody who'd been walking around for 6 months, where her dream of buying, getting a piece of the American pie, if you will, had been completely just, extinguished. And here we are. And for us, it was so simple, because I make it sound like the story came to us and it was so momentous, but we really didn't know what we were getting into. We just needed to qualify this borrower. And then when you find out the story behind what she's been dealing with, business owners, entrepreneurs are salt of the earth, specifically here in the US, with regards to the amount of sacrifice and sweat and blood and tears that goes into building the business. And then when you're finally starting to feel like you're making it, you walk into a bank and the bank says, you're still not good enough. I think that the idea that we have here within the new non-QM space to be able to help those, like you said, people who are doing what they can to kind of keep moving forward. Obviously, nobody wants to pay taxes, but being able to assist those folks is, and from an accounting perspective, I know that a lot of CPAs right around this time of year, specifically tax day was yesterday or 2 days ago, the accountants will tell their clients, hey, it's time to buy a home. You need a write-off because you're starting to make money, and next year's going to hurt unless you have a mortgage deduction. So again, non-QM has always been a great it's a great tool to have specifically for folks that maybe feel underserved. So
I think one more thing to point out in that is just that you talked about a $1.5 million home. I mean, the values of homes that people are buying in San Diego specifically, and all over the country for that matter. We have clients all over the country where, we had 20% increase in home values almost across the entire country in 2020. That qualifying under traditional lending becomes further and further out of reach. It becomes more complicated. So, but yeah.
I want to get back to Catie and Julia, and I wanted to see if I could maybe tie this conversation together between the two of you. Catie, you probably in divorce settlements, you probably see sometimes that folks need to, there might be multiple properties. There might be an estate situation where there's rental properties involved. And you, again, going back to the non-income earning spouse, that individual might have to refinance some of those loans or at least create a cash flow from those using mortgages to balance out their particular situation. Have you ever run across a situation where there's rental properties that need to be refinanced, but the individual doesn't have tax returns or income historically. Obviously, there's a settlement coming, et cetera, whatever that divorce settlement looks like. And the reason I wanted to bring Julia into it is that I wanted to then talk about DSCR or on property cash flow, and I'll let you kind of explain that for our audience. But Catie, have you had a situation where maybe there was an inheritance, or as they're splitting the estate, one of the parties has multiple rental properties that they have to tend to?
Absolutely. I mean, that does come up probably more often than not, actually. And when you have those and it's one party can't refinance, I actually have times where we have to incorporate into a marital settlement agreement that the payor, the spouse that's earning the income, will stay on for a period of time to allow for the other party to build the cash flow to be able to refinance those other properties. So that comes up quite frequently.
And Julia, tell us how DSCR would be a solution in this type of thing without having to involve the other spouse.
Yeah, so my DSCR program would be perfect for this borrower. This program allows you to.
Can you tell us what DSCR stands for?
DSCR stands for. Gosh, you're putting me on the spot with that one.
All right, I haven't written down.
I don't know why it's like not, I'm just DSCR, debt service coverage ratio. Sorry about that, Enzo. Debt service coverage ratio. So what we're trying to do with this program is cash flow the property instead of using any income from the borrower independently. So we wouldn't be using tax returns. We wouldn't be asking for W-2s, anything like that. We do need to see that they have a little bit of reserves, but we would look at the rents on the property, and then we would look at the PITI on the property, and we come up with a calculation. And if your property is cash flowing, it's renting for more than your PITI on the property. So it's over 1. So that's kind of a quick calculation that we use for that. But it allows a borrower to refinance or purchase a property, an investment property, without any income documentation. So that's great.
So it's 100% just using the rental property, the income that's derived from the rental, and you don't have to look at like personal tax returns or W-2s, pay stubs, nothing of the sort.
That's correct. Yep.
Okay. Yeah. That's an awesome program. We've been able to use that one quite a few times. And again, these are things that have popped up in the last 6-8 months for us as we're educating ourselves on the product type. Then all of a sudden we're like, oh, we can help you. We got a call yesterday, a borrower who has very little income, but has the means to put down 25% on a 4-unit out in, I think it's somewhere near Palm Desert. We're actually working with him. We've been looking at your product. So that's something that just comes up. And, if I would have gotten that call 6 months ago, I'm like, I don't think we can help you. You have no income, but technically the property cash flows itself, and we should be able to put something together for him. Mark, this question is a little bit more for you. With regards to preserving capital, I know that we have a couple of financial advisors on this call, and I know that their primary concern is often keeping assets under management. I can't tell you how many times we've come across a situation where a borrower comes in and says they want to buy a property. They find out because of either their tax situation, as far as what they write off, their business situation, how often they just say, you know what, I will pay cash for it. But I wanted to kind of talk to you a little bit about the tax ramifications of using capital. I know that the old adage is cash is king, especially for an investor, and using leverage to kind of maximize your opportunity within your portfolio, diversifying your by purchasing multiple properties as opposed to just one. Maybe you can touch on that, Mark. From a tax perspective, from a CPA perspective, how often you see that, and maybe when these products would be able to, this DSCR product would come in handy.
Yeah, I mean, obviously, if you have a portfolio that you have to sell stock to realize liquidity of it, there's a taxable event, right? So you're gonna sell off some of your assets to actually move that money over into a new investment vehicle. So there's tax issues. If you can leverage through this program and not have to sell off assets, you're not going to have that tax situation. If you can borrow against that portfolio, that also helps. I don't know the specifics on the program and how it works, but the tax side, obviously, when you liquidate a portfolio, that has some consequences with it. I do think that a lot of financial planners even even today's financial planners look at real estate as part of the portfolio, even though they're not getting paid on that. So I always encourage people to look at the whole picture, not just what you have under management. I think that's an important piece of the puzzle. So.
Perfect. Thank you. All right. And I think we're getting close to the questions section. We actually do have a question I'm going to address here momentarily, but I do want to talk about one more thing, and that's foreign nationals. Foreign nationals are folks who are non-resident aliens. So we have citizens, permanent resident aliens, otherwise known as green card holders. We also have work visas and investor visas, which are the various visas that are available. And those all work through conventional means. You can qualify for a conventional loan through H-1 visas, permanent resident alien cards, or citizenship. But this is specific for our neighbors to the south and neighbors to the north, the Canadians and the Mexican folks that come here and want to vacation here, want to own a piece of land here, but don't have, they're technically using it as a vacation home. I get these phone calls more often than not. And I'm going to refer back to Julia real quick about the Foreign National Program. I wanted to find out what the credit requirements are, just very briefly, and what the passport visa requirements are. And the assets, of course, of what would be needed in order to do a foreign national program, a foreign national loan for somebody coming in from either Mexico or any other country for that matter. But obviously, we're very close to Mexico, so we do get that call often.
Sure, yeah. So our foreign national program piggybacks with the DSCR program as well. But for foreign nationals in particular, the challenge is always the foreign assets and the money coming to the U.S. and then credit. So they don't have U.S. credit. So to solve for that problem, we require one credit reference letter from the country of origin. So as long as they've had one credit line in their country of origin, we'll be okay with that with a letter from them. FICO scores, we obviously don't need a FICO score requirement for that. And we do require some reserves. And we do require that the funds for closing come over 10 days before we close our transaction. So there's some coordinating with it. But other than that, we're not looking at any income documentation again, and we're cash flowing that property that they're looking to buy. Because they're a foreign national, they're only going to be eligible for an investment property. It does come up where they want to buy second homes or something like that. But for our program in particular, it is for investment properties only for them. So that's important there. But we'll cash flow the property. And as long as the rents cover the PITI, then they'll be good. It does require a little bit larger down payment for a foreign national than a U.S. citizen, though. That would be the one thing.
Okay. All right. I have a question now. Do you guys mind? Do you have anybody have anything else to add before we get into the questions? We have a few questions here that folks that have been waiting patiently, and thank you for doing that. Would any of you like to add anything at this point with regards to anything that we've discussed?
I wanted to add just one quick thing on the divorce. I have seen many a times where we have the wife who hasn't worked, stayed home with the kids, and is now divorcing and getting a settlement, getting half of the assets, and needs to refinance the home. It's the family home where she raised her kids, and she's in this predicament because she doesn't have income or a 2-year history of income, is starting her life over, essentially. One of the great programs that we have is an asset-only program too that can help that borrower. We would look at her alimony payout per month, and look at the assets that she has, and I can do a depletion calculation to add to the alimony income that she's receiving to help her qualify so that she can stay in the same school district that she has her kids in, stay in the same family neighborhood, and all of those things. So being able to utilize some assets can help with full doc income as well.
And that's a great point. I think, Catie, you'll probably agree that oftentimes, we look at the mechanics of a divorce, who's getting what's happening where, et cetera. And then there's the life aspect, like you mentioned, Julia, you mentioned, wanting to stay in the same school district, same neighborhood, you want your kids still playing on that sports team. And oftentimes, if you don't have a series of options or a solution to the problem, people have to disperse. They have to move away from that community, get into areas where, staying in the family home. And I've even heard, and maybe you can share share a little bit of insight on this, Catie, where it's better for the kids to stay in the family home, right? Especially during a tumultuous time where, parents are splitting up. Obviously, it's traumatic. It's something that they're going to have to deal with over time. I think staying in the family home ultimately helps their own, their mental health, their stability in their own little worlds. And I don't know, Catie, can you maybe just add to that a little bit? More the human element, because we've been talking a lot about the mechanics, right?
Well, every court and every judge that's sitting, I think anywhere, is going to say it's all for the children, right? They advocate for the children, and it's what's in their best interest. And so continuity, stability, consistency is all what the court is going to want. So if we can keep one party in the house for the children, that's the best scenario. One thing I wanted to ask Julia is, you were talking about spousal support or alimony. Same thing. Do you also look at child support? Because those are two different support orders.
Right. Yes, we do look at child support as well, and can use child support from the legal documentation that's been provided to us. We will require that. We do want to see that there's a history of receiving it. Not a super, I think it's 6 months, 3 to 6 months. And then a continuance. So when those children do get to 16 years old, it is a little bit tougher to use that income. But yes, we absolutely can use child support.
All right. Thank you so much for that. Do you guys mind if we move into the questions a little bit?
Sure.
All right. So this is specific to using DSCR for a purchase. How do you calculate the rent? Does the investment property already have to be rented at the time of the note?
No. So on a purchase transaction, if someone's looking to buy an investment property, we're going to go off the rental survey from the appraisal. So the appraiser's opinion of rent. That's what we're going to use for the rental income. And then you'll come up with your PITI on the property, depending on what rate you qualify for. We take the rents, we divide it by the PITI on the property, and that's how you get your debt service coverage ratio, which would be above 1 if it's renting for more than or if it's renting for more than the PITI on the property.
Perfect.
But we do have options for if it's not cash flowing as well. So if your DSCR is under 1, we still have some options for you. The rates are just not as advantageous.
You can use interest only on that to qualify, if I'm not mistaken, right?
That's correct. Yeah. And we do have a 40-year available as well. So, and we'll use the interest only payment to calculate that DSCR, which is beneficial.
Okay. Another question we have here is what are the down payment requirements for bank statement loans?
On a bank statement loan, we can go all the way up to a 90% LTV. That's going to require a FICO score of at least 720, 680. It's going to require a 680 FICO to go up to 90%. And we can go up to 90% all the way up to 2 million. So even in our markets here in San Diego and Orange County, we have solutions for those borrowers.
So up to 2 million with only 10% down.
Correct.
All right. New money is where it's at. That's what I'm saying. So, all right. And then we have another question here. Let's see. Are the interest rates generally higher with non-QM loans? And if you want to take a stab at that one, because I don't want to get into rate quoting, but at the same time, we've got to talk about it, right?
Yeah. I mean, rates do tend to be a little bit higher for these types of programs. They're a little bit tougher. The investors are different. So they do tend to be a little bit higher than conventional rates.
Yeah, on a general rule, I usually say it's anywhere from 3/4 to a point higher than a prime rate. The one thing that to keep in mind, though, is that we often take advantage of the interest-only option, which allows the borrowers to, instead of having to pay principal, they only pay interest, which is a much lower payment. Obviously, you're not contributing towards principal, but from a cash flow perspective, it allows you to get into the house, kind of, get stabilized, set up that foundation, and contribute principal as you see fit. Now, oftentimes these loans, they're usually not, what is it, the retention time period, usually the average time period that somebody has one of your loans? Is it 2 to 3 years, maybe even less?
I would say 2 to 3 years. Usually people are trying to get into these types of loans to either get into the home or for whatever reason they have the situation where they need a non-QM loan. But usually the end goal is to get them to qualify with tax returns rather, for a rate that's going to be a little bit better than a non-QM rate.
Okay.
So they're not a long-term solution, but it is a solution.
All right. So lastly, I think this is one of our is cash out available. Cash out refinance is available for all non-QM products.
Yeah, we do cash out on all programs. We have Full Doc, we have our bank statement program, and then we have our DSCR program. Those are our three main programs. But within each of those, there's a ton of niche stuff that we can do. But yes, cash out is available on all of them.
And can the cash out be used as reserves?
Yes. Yeah, that's a huge one. Cash out can be used as reserves. So
that's right.
If your borrower is coming up short on reserves, which we see quite often, if they are doing a cash out loan, we can use that to meet the reserve requirement.
Okay. Perfect. I think that's, let me see if we have any more questions. I want to be mindful of your time. I said we were going to be 45 minutes and we're 2 minutes early. Look at that. Okay, here we go. One more. This is actually a really good question. What about refinancing a house where the owner has 70% equity, but has missed some payments in the last 12 months? Owner qualifies for the mortgage amount based on income, but regular lenders are requiring 12 months of no missed payments. So in other words, he's been late a little bit, not behind, but late.
Yeah, so we have some tolerance for late mortgage payments. Installment payments or revolving credit cards, we don't have a guideline for that. But when it comes to a mortgage, we do like to see that there is a clean 12-month mortgage history. But if we see one or maybe two mortgage lates and there's a good reason for it, then we can, with an exception, quite possibly do that loan. If it's just one mortgage late, we'll deduct 5% from the maximum LTV that they qualify for, and that's not a problem. But if it's more than one mortgage late, it is going to be case by case. But I have seen where it's rolling. There's a story. Sometimes there's a financial planner involved that or somebody handling the finances missed one payment, somebody that has a multiple properties, something like that. But there's a tolerance for one late mortgage payment in the last 12 months.
Perfect. Well, I think that pretty much wraps it up. I want to thank our panel. I want to thank Mark Wilson. I want to thank Catie Young and Julia Sherouse, which I learned how to pronounce it this morning because I've been pronouncing it wrong. I've been botching it. I also want to thank our attendees. Thank you very much for joining us today. It's an honor to have you take this time out of your day to take this information in, and hopefully it's something that you'll be able to use. We're going to be sending out a follow-up email after this with some information. It actually is a flow sheet of the types of loans that you might be able to kind of think about, the types of buyers, types of sellers also as they step into their next investment, and then some of the solutions that we have at hand. Obviously, if you have any specific questions or if you have any clients that you can think of that might require the services from Catie or Mark, CPA and family divorce attorney, feel free to email me directly. I'll be happy to pass along their information. Julia, she's one of our reps, so we work with her regularly on the loan side. But thank you so much. Enjoy the rest of your week, and I appreciate you being a part of this.